January 2025 wasn't a natural disaster. It was an actuarial correction. Look at the ashes of the Palisades and Eaton fires. 12,000 structures were wiped off the map, not because of bad luck, but because the American housing market is built on a fundamental lie. We built an entire civilization out of kindling and called it efficient. We called it stick-built. The insurers call it a total loss. That is why State Farm didn't just panic. They calculated. They cut 30,000 policies in a single stroke, abandoning the wood frame market to save their own balance sheets. They know the physics of your home better than you do. They know that what you call an asset is actually a pile of uninsurable fuel waiting for a spark. The era of cheap risks is dead. Welcome to the financial incinerator. To understand why your property value is evaporating, you have to stop looking at the weather report and start looking at the ledger. The catastrophic events of early 2025 were the tipping point. When the Palisades and Eaton fires consumed over 12,000 structures in Los Angeles County, they didn't just burn wood, they burned the actuarial assumptions that kept the American housing market alive. This isn't a cycle. It is a permanent repricing of reality. State Farm's decision to non-renew 30,000 residential policies wasn't a negotiation tactic, it was an evacuation. They looked at the density of wood frame construction in the wildland-urban interface and realized the math no longer works. The risk isn't probable. It is inevitable. And what is the government's solution? The California Fair Plan, a state-backed insurer of last resort that is now bloated, toxic, and structurally insolvent. By February 2025, after the smoke cleared, the plan reported a $1 billion deficit. Who pays for that? You do. Starting June 1st, policyholders are hit with a 17% surcharge. You are paying a hazard tax simply to keep a system on life support that cannot save you. Shift your eyes to Florida, and the picture is even bleaker. While California burns, Florida is drowning in risk premiums. The market there has ruthlessly segmented into two classes, concrete and wood. If you own a wood frame home, you are financially radioactive. Insurers are charging premiums 15 to 30% higher for wood structures compared to masonry. Why? Because in a high wind event, wood is structurally inferior. It rots, it warps, and it lifts. The private market has largely abandoned these stick-built liabilities, leaving homeowners trapped in citizens' property insurance, which is legally mandated to hike rates by 14% this year alone. The system isn't failing. It is actively trying to get rid of you. But why now? Why are multi-billion-dollar corporations running away from your premiums? To understand the collapse, you have to follow the money upstream to the reinsurance market. These are the shadow titans that insure the insurance companies. They don't care about your picket fence. They care about global capital preservation. In 2023, property catastrophe reinsurance rates jumped 33%. This wasn't a nudge, it was a stranglehold. Global capital looked at the American wood frame housing stock, looked at the climate models, and decided it was a bad bet. When reinsurers tighten the screws, primary carriers like State Farm and Allstate are left holding a toxic bag of risk. They have two choices: pass the cost to you or sever the limb. In states like California, where regulations cap how much they can bleed you, they chose amputation. Do not be fooled by the narrative that these companies are struggling. In 2024, 22 publicly traded insurers reported over $36 billion in profit, yet they still canceled coverage for millions. This is the profit paradox. They are making money today by ensuring they don't lose everything tomorrow. They are modeling a future where stick-built construction simply cannot survive the intensity of modern wildfires and hurricanes. They are cashing out their chips before the house burns down. The government tries to intervene with mandates like Zone Zero in California, requiring a 5-foot non-combustible buffer around homes. It sounds logical, but it is physically delusional for existing wood homes. If your house is made of fuel, clearing the brush is just rearranging deck chairs on the Titanic. A wood fence attached to a wood siding acts as a wick, guiding the fire directly into the structure. Insurers know this. That is why they are ignoring mitigation credits and issuing non-renewals instead. They know that no amount of landscaping can change the fact that wood burns. And here is the final nail in the coffin: the banks. The insurance crisis is rapidly metastasizing into a mortgage crisis. It is called blue lining. Lenders are quietly beginning to restrict mortgages in climate risk zones. They know that if a property cannot be insured, it is worthless as collateral. If you lose your insurance, you technically default on your mortgage. You are forced into force-placed insurance, which costs up to 10 times more and only protects the bank's equity, not yours. The system is designed to protect the lender, the insurer, and the reinsurer. You are the only one left without a chair when the music stops. This crisis is, at its core, a judgment on physics. It is a ruthless war between materials, and wood is losing. The insurance industry has stopped looking at homes and started looking at fuel loads. They are running the numbers, and the difference is staggering. Consider the physics. Wood is organic. It absorbs water, it feeds mold, and most critically, it burns. Modern fire-resistant treatments are just lipstick on a corpse. In a megafire, a wood frame is fuel. Contrast that with insulated concrete forms, ICF, or masonry. Concrete doesn't burn. It has a 4-hour fire rating. In a hurricane, a solid concrete wall acts as a monolith against winds exceeding 200 miles per hour. A wood frame? It relies on nails and straps, mechanical connections that fail under repetitive stress. The market used to ignore this difference. Now it is pricing it in with brutal efficiency. You have been sold a lie about affordability. The industry tells you that stick-built is cheaper, and on day one, it is. Building with concrete or ICF might cost 10 to 15% more upfront. For a typical home, that is maybe $30,000. But look at the 10-year timeline. A wood home in a high-risk zone is a financial bleed. Between higher insurance premiums, if you can get coverage at all, energy inefficiency, and maintenance, a wood home costs significantly more to own. Data shows that the insurance savings alone for concrete structures can range from 30 to 50%. Over a decade, a concrete home saves you nearly $60,000 in total cost of ownership compared to a wood equivalent. The cheap option is actually the most expensive mistake you will ever make. This creates a new, terrifying class of real estate: the stranded asset. We are seeing homes that are physically habitable but financially toxic. If you try to sell a wood frame home in a wildfire zone today, the buyer will demand to see the insurance quote. When they see a premium that rivals the mortgage payment or a rejection letter, the deal dies. Your equity is trapped in the walls, and you can't get it out. You don't own a home. You own a liability that no one else can afford to take off your hands. The insurance nightmare is not a temporary glitch. It is a structural correction of the American housing market. For decades, the true cost of building disposable, combustible homes in volatile climates was subsidized by cheap reinsurance and underestimated risk models. That subsidy is dead. The financial safety net has been withdrawn, and it is never coming back. We are witnessing the violent bifurcation of the housing market. On one side, you have fortified housing, concrete, steel, ICF, assets built for the rich to survive the new century. On the other, you have legacy housing, the wood frame American dream, rapidly mutating into a luxury burden that bleeds its owners dry. The market is effectively segregating safety by class. The insurers have already made their choice. By retreating from California and Florida, they are sending a deafening signal. Build to survive the fire and the wind, or prepare to pay for your own total loss. Do not look to the government for salvation. The moratoriums preventing cancellations are nothing more than a temporary pause button. They are a 1-year stay of execution. When those moratoriums expire, the actuaries will return to finish the job, and they will purge these risks from their books with zero hesitation. The question is no longer whether you can afford the mortgage. The question is whether you can afford the reality of the materials protecting you. The fire is coming for your equity. And this time, there is no one left to write the check.